In this session, I will be looking at the mortgage-backed securities sector because today this sector is becoming more and more popular with the investors, and it has created a unique way of investing in the real estate sector. So, looking at it, if at all I have to understand the mortgage-backed securities, first of all, it's better to understand the prime characteristics of the mortgage itself. And after that, how these mortgages are translated into mortgage backed securities is something which we will look at. So, whenever we talk about a mortgage, it's basically a loan that I am taking for purchasing a real estate. A loan to purchase a real estate, it could be residential or commercial. Any purchase, if I am doing it with a loan and keeping the same real estate property as the collateral, that is what we are calling as a mortgage. So, against that loan, it is required that the borrower should make a series of payments, probably comprising of interest and some portion of the principal. The borrower is required to make a series of payments over the period of the loan, and in case the borrower defaults, the lender will have the right to have a claim on the collateral. That is what is a typical characteristic of a mortgage loan. And in this process, whatever the interest rate that is being charged is what we typically call as a mortgage rate. I mean, the interest rate on a loan, probably you can use that same word, but otherwise it's better to use a word called mortgage rate. And the most common form of mortgage which we see is the residential mortgage, for which the bank or any lender, they assess the credit worthiness of the borrower and give a loan against which they get that particular underlying residential real estate as the collateral. And generally the payment terms that are associated with the mortgage loan result in a fixed rate level payment fully amortized. Mean the mortgage rate for the entire period, even if I have borrowed for a 30-year period, the general scenario is the interest rate for the entire 30 years is fixed. Every month, the borrower is supposed to make an equal amount repayment as a part of the loan, and by the time the 30 years come up, by the end of the 30th year, no loan is outstanding. That is what is called as fully amortized. Whatever the principal that you have taken, that is spread fully over the 30-year period itself. Right? These are the three important characteristics that we see with any typical mortgage loan. The interest rate is fixed. The payments are uniform for the entire 30-year period and fully amortized. By the end of the 30 years, there is nothing else that is outstanding to be paid. This is the most common component, which means when I am doing an equal repayment, there is some amount of principal and some amount of interest that would be computed in the process, and allocation of the total prepayment amount to the principal as well as the interest can be different for different periods. Now let me take a small example to illustrate the same. Let me use a spreadsheet. Well, let's say I'm planning to borrow a principal of 500,000 at a prevailing interest rate per year. Interest rate per year, let me assume it as 6%, and I want to borrow number of years. I want to borrow for 30 years. Now if I want to find out the EMI, the equal monthly installment, because we are talking about a fixed rate level payment. That level payment is what I call as equal monthly installment. So I can use the PMT function, which can give me that scenario. Yeah, the only thing now is, instead of taking an interest rate of 6% per year, I take it as 6% by 12, which is 0.5% per year. And the number of years, number of periods, instead of taking it as 30 years, I'll take it as 360 months. And the loan amount stands to be 500,000. So this says that I should pay close to 3,000 bucks. $3,000, $2,997.75 every period to make sure that my loan gets repaid. At the end of 30 years, the loan gets completely repaid off. And in this process, if I want to know what is the contribution to the interest and the principal every month, okay, right from month number 1 to, I have 360 months in this, right? So let me take it for the entire 360 months. Okay, I'm taking this numbers for the entire 360 months. All right. Here, I would like to find out the principal part of this loan, and I would like to know the interest part. Of course, if I want to find out the interest part, it is straightforward. Whatever is the principal that is outstanding, the way we make a schedule, okay, initial principal for the first month, let me call it as beginning principal at the beginning of the period. So on that, some interest is being paid, and principal repayment and ending principal. This is how I make a schedule. So the beginning principal probably is 500,000. The interest which I am paying on it is whatever is the beginning principal that is there. I pay 6% by 12. That is the interest that is being paid for it. And if I want to know, but I am paying in EMI of minus 2,997. So the remaining 497 is going towards the principal repayment. So I am subtracting the interest portion from it. This is saying that this is going towards the principal repayment, which means my principal is getting reduced by this much amount. So at the end of the first month, the outstanding principal from my side is $499,502. Thus that becomes the beginning principal for the next period. And let me see if this works out now. If I'm dragging it, yes, this is the interest repayment, this is the principal repayment. So my principal is coming out to this level. Now when I drag this across, go down, you see by the end of the 360th month, the principal that is outstanding is 0. This particular table is what we call as the amortization schedule. This particular table is what we generally classify as amortization table. A schedule containing the principal as well as the interest repayments of a tradition of any kind of a loan. Now, a few things from this. What we are seeing is for these kind of securities, the in principle initially it is much lesser, but as the time period is increasing, the principal is increasing gradually, whereas the interest is decreasing gradually. And so these are the two important things that are there. And along with that, these mortgages generally charge a servicing fee, which is primarily used to cover the administration costs, some kind of documentations and some such kind of costs, along with a collection cost, because on a regular basis, in case the interest and the principal repayments do not happen, giving some calls or sending persons, all these things come as a part of a servicing cost or servicing fee. Generally, some this kind of job is outsourced to some third parties also, who charge a kind of a servicing fee for making sure that they are collecting all the payments from all the borrowers on time. And this rate is generally built into the mortgage rate itself. So if I when I said probably the 6% is the mortgage, 6% is the mortgage rate, it may probably if 0.25% is the servicing fee, probably the actual mortgage part of it is only 5.75%, whereas 0.25% is purely for the servicing part. It is already included as a part of the mortgaging rate itself. That's so the only 5.75% will form the net interest kind of a rate for this particular loan. So even if more of if I look at this, the principal is increasing as the time increases, the interest is decreasing, and even the servicing fee also keeps decreasing as the time increases, because the interest portion is getting reduced. The servicing fee portion also will typically get reduced. Now, here the lender is exposed very heavily to this prepayment risk, which means the borrower can make an early repayment of the loan. See, logically, early repayment is more to do with the principal part. See, for this month, let's say the scheduled repayment of the loan is $520.6. But what if the person comes forward and say, I'll do $1,000 repayment here instead of 520.6? If the borrower says, I'm going to pay $1,000 here, that is what we call as prepayment. So wherever the borrower is making more than the scheduled, see, this much of amount is definitely required to be paid. So in some cases, we see that the borrower ends up paying more than that particular amount. And typically when a borrower is paying more, what we observe is the general scenario is the interest will keep coming down. The total interest that the lender would be receiving will come down. So lender is exposed to a prepayment risk. because he is not receiving the total interest which he initially thought he would be receiving over the life of the loan. He would be receiving much lesser. So the prepayment risk is one of the serious problems associated with the mortgage loans, which differentiates a mortgage loan probably from other kinds of loans and bonds. There is a heavy possibility of prepayment. So in this session, we'll try to cover a lot of aspects associated with the prepayment and how do we address the various aspects of prepayment risk that could exist. And so any excess of the necessary monthly amount is what we call as prepayment, and in some cases even the payment will happen for the less than, the overall balance will be negotiated for less than the outstanding principal balance, which also will reduce the interest payment. So that is what is called as a curtailment. So the mortgage loan is generally exposed both to prepayments as well as curtailment. So as a lender, I need to have some kind of processes in place handling the prepayments as well as curtailments. This particular part is what we call as amortization schedule. Generally using a spreadsheet, this can be prepared quite comfortably, and whatever is the the prepayment that is there also, even that could be built into the model, which could result in acceleration of the acceleration of the mortgage loan, or sometimes if the necessary payment is not being done, it can even extend the period of the loan. But because this loan generally is a fixed rate, level payment, fully amortized kind of a loan, by the end of 30 years exactly I should see that there is no more principal that is outstanding in the process, right? So these are the basic characteristics that are associated with any mortgage loan. Now we should start looking at how is a mortgage backed security created using this mortgage loan. So the next point is focusing on creation of mortgage backed security using these mortgage loans. So when we talk about the mortgage pass-through securities, right? The intention is you pool a series of mortgages. So loan 1, loan 2, loan 3, loan 4, loan N. So a pool of loans put together is created as one instrument, called as mortgage pass-through securities. So typically this is what is a pool that is created, and from this pool various instruments are being issued to various investors. So investor 1, investor 2, investor 3 and so on. So what is happening in this process? These loans are acting as collateral for this particular company which has created the pool. It is issuing, let's say, bonds. It is raising capital. Look at it like this. This particular company which is creating a pool, think of this company as raising capital by issuing bonds and keeping these as the collateral, keeping the various real estate properties, keeping the various loans that are outstanding as the collateral. This particular structure is what we call as a mortgage pass-through security. Basically, we are creating securities like bonds which have the underlying mortgage as the collateral. So each mortgage which is being created in that mechanism is called as a securitized mortgage, and this kind of a setup is what we are treating as a mortgage pass-through security. And probably these loans can have completely different characteristics. Each one could be for a different maturity period, right? Different time period of the loan, different mortgage rate. All these things can very well exist for each of these loans. So what is typically looked at is a weighted average maturity, which is purely based on the weighted average of the maturity of each of the individuals, where the weighing is based on the principal outstanding of each of the mortgage divided by the total principal outstanding. That is what is the weight that is given to each of the mortgage, and from there the weighted average maturity is being derived. The same way, weighted average coupon for the payment, because what we typically see is the investors need to be made an interest and principal repayment, because this is a bond. Some kind of interest payment, some kind of principal payments have to be done to the investors. So the coupon will indicate what would be the typical interest that would be, or what would be the regular periodic payment that would be paid on the bond, and even the principal would talk about how much of principal would be returned to the investors at each of the aspects. So this is one of the strong things, and probably people tend to invest in these mortgage-backed securities or in this pool for the simple reason that there is a backing, very strong collateral that is backed by the various mortgages in the pool. So the risk is much lesser. So how these pool? See, generally these companies, the companies which form this pool, we can categorize them as agency or even non-agency. Agency is more like either government or government sponsored kind of entities, whereas the non-agency is more of private. So you can categorize this pool creators as either agency or non-agency. So when you are looking at agency one, probably they have very good government sponsorship and government guarantee exists, which means the risk associated with them is comparatively lower. So the chances of default are comparatively lesser. So the investors will show some kind of an interest to invest into the pool. Now, how this pool structures the cash flows to each of these investors, how the interest payments happen, what is paid as a coupon, what is the payment at the principal, are there any principal repayments intermediately. So all these things differentiate one pass through from the other. So generally whatever the investors, the borrowers for each of the loan, they make an interest as well as principal repayments, right? As a part of their EMI, they make interest and principal repayment. So that money will come to the pool, and that would be used for payment towards the various investors on a regular basis. So from whatever the amount that is coming from the borrowers into the pool out of the various mortgages, the cash flows for the investors are typically structured. right? The basic preliminary thing is whatever comes from the borrowers in the form of interest and principal, that is what is redirected to that is what is redirected to the investors in the form of coupons and the principal repayment. And one more advantage of these pass-throughs is they are actually traded in the secondary market. There is an exchange where these pool of securities can very well be traded, which means the underlying real estate, people don't want to invest directly in the underlying real estate because that is more and more illiquid. Whereas investing in mortgage backed or mortgage pool of securities converts the illiquidity to liquidity. It makes the security more and more liquid because I can buy. See, one, I'm getting an exposure to the investment in the mortgage market itself, in the real estate market itself, without directly purchasing a real estate which is more illiquid. And at the same time, I can very well exit my position by selling off my shares or my selling off my units in the secondary market. So it is giving me more and more liquidity also. That particular process is actually called as securitization, wherein the illiquid security is getting converted into liquid. And the other thing which we generally see is against one pool itself, multiple classes of securities, probably depending on the needs of different individual investors, different classes of securities can be created. Probably from this pool, some portion I create a class A kind of a security where coupon will be much lesser and risk and will have high priority. And similarly, I can create a class B kind of securities where coupon will be slightly higher because I'll give them a secondary priority on the claims. Like that, a kind of structuring also can be done based on the cash flows that are coming from the interest and the principal repayments. So even against one single pool itself, multiple kinds of instruments can be created with multiple characteristics addressing the risk behaviors of the various investors also. In most of the cases, what we see from an agency perspective in the United States, we see organizations like Ginnie Mae, Fannie Mae, and Freddie Mac. These are the typical government or government sponsored kind of entities which participate in the creation of pools and issuing securities to the investors. And most of the times, what we see with respect to the mortgage pass through securities is again they are exposed heavily to the prepayment risk because the underlying security for them is a pool of mortgages. So if the prepayment happens on the underlying mortgage, even the same is being passed on to the investors of the mortgage pass-through securities. Mean the more prepayment comes, the more prepayment is paid to the investors, and because of this, generally we observe that more prepayments happen when the interest rates are very low or when the mortgage rates are very low, which means even though the lender is getting a big principal amount, he is exposed more to reinvestment risk because he cannot reinvest the funds better because the interest rates prevailing in the market are much lower at that point. So there is a lot of exposure to prepayment risk. Now that becomes one of the key aspects of mortgage backed securities. So there are, I mean, we will be dealing with what are the various methods that are available to compute the speed, right, to compute or measure the prepayment speed, assess what could be the amount of prepayment, what are the key factors that impact the prepayment. All these things we can very well look at in the next few minutes. All right. So this is how a mortgage pass-through security is created based on the underlying mortgage securities. Now that we have understood that prepayments can really impact the cash flows of a mortgage pass-through security, because we were discussing that prepayment risk is heavily prevalent. So because of this prepayment, I really need to do some kind of prediction as to, in a particular period, what could be the extent of prepayment that could be done on a particular mortgage loans. For that, I really need to look at some kind of benchmarks that are available. And what we are saying is, in the industry, there are two common kinds of tools. One is the conditional prepayment rate and the Public Securities Association PSA. These are the commonly available benchmarks that are there in the industry to assess or to predict what could be the typical percentage of prepayment or the amount of prepayment that we can assume on this particular loan. So when I look at the conditional prepayment rate, it is saying that it's an annual figure at which a mortgage pool balance, whatever is the outstanding principal that is there, is assumed to be prepaid. So is 5% of the principal assumed to be prepaid? Then I have CPR as 5%. So some kind of a benchmark that is being set, saying that this particular proportion of the outstanding mortgage balance is assumed to be prepaid during this particular month. And deciding of this CPR is purely based on historical data, historical prepayment scenario, as well as the current state of the economy, because we have discussed earlier that when the economy is booming very heavily, there is a possibility of the interest rates increasing. But if the economy is not doing well, there is a possibility of not too much of growth opportunities, and the interest rates will fall, and because of which people think of repaying the loans quite quicker. So the prepayment rates could be higher in that particular scenario. So what we are saying is the CPR, whatever is being used as a benchmark, it is decided based on the past history of prepayments along with the state of the economy. And people use this CPR to convert into a mechanism called single mortgage mortality or single monthly mortality figure. Whatever is the annual figure, they convert it into a single monthly mortality figure to primarily assess what should be the amount. This helps me to find out the amount in dollars that I can expect as a prepayment in this particular month. This helps me in computing the amount in dollars that I should expect as a prepayment in the particular month. The more common formula here is single monthly mortality is equal to 1 minus of 1 minus conditional prepayment rate to the power 1 by 12. So if at all I am saying that if at all I am saying that the CPR is equal to 5%, the SMM, single monthly mortality, will come out as 1 minus of 1 minus 5% to the power 1 by 12. So on a monthly basis, I can expect that around 0.42% of the principal outstanding. We'll look at how do I calculate what is the amount that can be prepaid. So this is the SMM factor that I am trying to find out for each of the months. So if I am assuming that the CPR is 5%, the SMM, single monthly mortality, is assumed to come out to 0.4265%. And so that is how I use the CPR to predict how much could be prepaid. Now let's say here I have, okay, let me take this particular, I am in the 10th month. So the principal outstanding till date is 495,429. Okay, let me take this example. The principal outstanding is 495,429, and whatever is the scheduled monthly payment, the scheduled monthly payment for this is the principal repayment for this period is 520. Now what it says is the prepayment amount. This is not prepayment, this is a schedule. So out of this, whatever is outstanding, as per my schedule, I have to pay this much. So in this model, it is assumed that the prepayment amount is whatever is the total outstanding minus whatever is the scheduled payment for this period. You multiply this with the single monthly mortality. So telling me that in this scenario, there is an expectation that the prepayment can happen for almost $2,111. That is the expected prepayment amount in this kind of a scenario. So once I am able to find out the single monthly mortality, this is where I look at. Once I find out the single monthly mortality, which I compute from the CPR using this process, I can find out the prepayment for that particular month, for the 10th month in our data. If I want to find out what could be the prepayment, I will take it as single monthly mortality 0.004265 into whatever is the balance that is there at the beginning of the month minus whatever is the scheduled payment for that particular month. So that is what will take me through what could be the prepayment that I can expect during that particular month. Now, there is one more standard as we were discussing, the PSA, the Public Securities Association benchmark. It makes a very good assumption. It says that the prepayment rate increases as the age of the mortgage actually increases. So here they even came out with a mechanism saying the mortgage rate probably it keeps increasing like this as the age is increasing, and there is a possibility that it can stable off at. So this is your prepayment rate. This is your prepayment rate, and this is your year or probably month. So as the age or months are increasing, it says that the prepayment rate is going to increase. Initial years probably the prepayment rate is not that heavy, but after a certain point in time, as the maturity increases, the prepayment point also increases, and after a certain point probably it can get stable down. So generally people use the common conventions as 100 PSA or 150 PSA kind of numbers. So these are the typical benchmarks. And in a typical 100 PSA or 100% PSA kind of stuff, what they have made is the CPR will be 0.2% for the first month, increases by 0.2% per month up to 30 months. So it will start from zero point 0.2, zero point 0.4, zero point 0.6, and by the time it reaches 30 months, this is around 6%. 30 into zero point 0.2, this is around 6%, and it will stay at 6% forever. That is the CPR until so after that, from the CPR I can very well get into the computation of SMM, and using that SMM I can find out what could be the prepayment amount for the particular period. So in the earlier example itself, if I want for the 10th month, I cannot take CPR as 5%. For the 10th month, going with this assumption, CPR will come out only as 2%. So for the 10th month, the CPR is only 2%, which means the SMM will come out to be this much. And from here, I can find out that the prepayment amount in the 10th month is expected to be around $832. But if I am saying, no, I am not going with 100 PSA benchmark, but I will go with 150 PSA benchmark or 200 PSA benchmark, it means that the prepayment rates are faster. If I am using a bigger number, I am assuming that the prepayment rate is more faster. Otherwise, if I am using a 50 PSA or something, I look at the prepayment rates to be much smaller. Because the only difference is the CPR may still remain the same, but when I am using a 150 PSA, probably it is as good as assuming whatever is the CPR, multiply it by 150%. So instead of 2%, I'll take the 3% directly for the CPR and then use it for the computation of prepayment. Now let's understand one thing. If the CPR is 2%, probably this is 832.5. 832.5. But if I make CPR as 4%, just for understanding, this is 1680. Actually speaking, this is not double of this, right? So the arithmetic relationship does not hold true here. So it means that if the CPR is doubled, it doesn't mean that the prepayment amount is also doubled or vice versa. But generally we see the PSA is just set as a standard for finding out the CPR, and from the CPR I can use that to compute the single monthly mortality, which will help me in computing what could be expected as the prepayment amount for the particular period, right? The next thing that is worth looking at in this context is for majority of the mortgage backed security transactions, people prefer looking at average life rather than the complete life. Rather than looking at the true life of the mortgage security, the full life of the mortgage security, people focus on looking at the average life, because of the prepayments. What you see is, if the prepayments are higher, the life of the mortgage is much lesser, and if the prepayments are lesser, the life is going to be much higher. So now that we cannot assess what could be the typical prepayments, or even some kind of basic assessment of the prepayment has to happen, what we are suggesting is, for a mortgage backed security, it is better to look at the average life rather than the complete life. And average life is nothing but whatever is that average time in which all the scheduled principal and the interest payments as well as the expected prepayments are received. So whatever is the expected prepayment to be received, let's say in this same example, right, in the same Excel sheet, what I can do is I can create one more element for expected prepayments. Going with the 100 PSA mechanism, what I can think of is, okay, I'll take the CPRs based on the 100 PSA mechanism. I'll take it as 0.2%, 0.4%, and like this up to the 30, I will take it, let's say, as 6%. And even from this, I'll take it as 6%, right? Until the last, I'll go ahead up to the 360th thing, I'll go ahead as 6%. These are what are my CPRs for this particular example. Now what I can do, I can compute the SMM. Okay, I will take the SMM as 1 minus of 1 minus CPR to the power 1 by 12. That is the SMM. Multiply this SMM by whatever is the principal outstanding minus whatever is the scheduled principal that needs to be paid during this particular month. So it comes out that this is the expected prepayment rate. So even after the expected prepayment also happens, so the updated, if I am expecting that this is the prepayment rate, my principal, ending principal will get updated to this particular number. The same logic I will continue. Now what I am going to see is, because of this, now this is going to be this number is updated. No. So the ending principal, this formula I'll drag across, and now what I could see is probably by around 178th month, by around 178th month, on an average, I am expecting that the loan is completely getting paid off, assuming the prepayments going with the industry benchmark and all these things. I am assuming that by 178th month itself, the loan is getting completely paid off. The scheduled interest and the principals, as well as the expected prepayments, all of them are getting taken care of by the time we reach the 178th month itself. That is what we are typically calling as the average life of the MBS, right? So any kind, see, sometimes what could happen when the mortgage rates are falling, when the interest rates are falling, the prepayment rate can increase, and which means the average life is going to go down. If the prepayments are much more higher, I am looking at the average life going down. Whereas if the interest rates are increasing, so this is where we talk about two risks. Interest rates decrease, mortgages or prepayments increase. So that means average life will decrease. Similarly, if the interest rates increase, prepayments decrease and average life will increase. So here, this particular thing, when the interest rates actually go down, we are calling it as a contraction risk. And when the interest rates are going up, we are calling it as extension risk. Both are a problem. Let's say if the interest rates are going up, what we could see, if the prepayment rates are going down, prepayment amounts, expected prepayments are going down, the party who has invested in the MBS, he is expecting to receive some predefined prepayment, right? As per the SMM computation, we are expecting that some amount will come in the form of prepayment, but that prepayments have actually come down, which means this party is having a delay in getting the capital, getting a delay in getting the principal amount. So he is not able to utilize or take advantage of rising interest rates. If he had got higher amounts of principal here, he could have reinvested them at higher interest rates and could have gained something more. But because the prepayments have gone down drastically, he is not able to get the required principal amount on time, and he is not able to take the advantage of the reinvestment process. So that is one of the major risks, especially with the growing interest rates. Whereas if the interest rate is falling, as I have already indicated, the prepayments can typically occur, and because of this prepayment, though the investors are getting more and more of the principal, they don't know where to reinvest it, because they are forced to reinvest that money at a lesser interest rates, because the market prevailing rates have fallen drastically. So just looking at that aspect itself, if I see a contraction risk, what is going to happen if the interest rates are falling? The reinvestment risk is a bigger issue. Whenever the interest rates fall, it is expected that the prepayments will increase, and if the prepayments are increasing, the investor is forced to reinvest all those proceeds at a much lesser prevailing interest rate. And the interesting aspect is, we see that the mortgage backed securities have a feature more or less like an embedded call option. Why? In a call option, the investor has the right to buy the shares at a pre-specified price at a future date. The same thing in case of mortgage backed security, in case of mortgages, the borrower has the right to surrender the loan, pay back the loan, and reissue it at a lesser rate of interest. So without any kind of penalty, if at all there has been no penalties on the process, the borrower has the right to surrender the loan, pay back the complete loan early itself, and he can get it refinanced at a lower rate. Because of that, when the interest rates are much lesser in the market, the borrower can typically close his existing loan, which must be at a very higher rate of interest. He could get it refinanced at a much lesser rate of interest. So just like a call option, at lesser interest rates, the mortgage backed security also exhibits a kind of negative convexity. A negative convexity below a particular interest rate, and after a particular interest rate, it exhibits the same positive convexity itself. So this is one more thing. If the interest rates are falling drastically, one is a reinvestment risk coming into picture, and the second one is a negative convexity, which is displayed just like for a call option kind of scenario. Whereas when the interest rates are increasing, I have already discussed, the prepayments will actually come down. So the investors who are expecting that we will receive this much of principal, we can reinvest at higher rates, they are not able to receive that much of a principal, so they are not able to take advantage of rising interest rates at all. Now here one more dimension which I should look at is what are the factors that really impact the prepayment rates. So we are looking at from three dimensions. One is the existing interest rates or the mortgage borrowing rate. If I see that the interest rates over a period have fallen, mortgage rates have fallen, which means when the people have borrowed earlier, the interest rate, let's say, is around 10%, but now it's around 7%. There is a lot of chance that all these people here, they will pay back, they'll do a prepayment or even a loan completion, they'll pay back everything whichever was taken at 10%. The whole prepayments happen for them and a fresh loan issue happens at this interest rate. So whenever we are seeing that the difference between the interest rate when they have actually taken the loan and the current prevailing mortgage rate is at least 2%, the chances of refinancing of all those loans will happen, which means that much proportion of prepayment is going to happen in the market. But with the only exception that probably if this 10 to 7 has been occurring quite constantly, I mean, very recently the 10 came to 7 and again went to 10, again came to 7, again went to 10. So, if this has been a continuous repeating, quickly volatile kind of a process, what could have happened is some people might have refinanced here, some people might have got their homes refinanced at this rate. So, it could have happened that a good proportion of people might have already got their refinancing done at a lesser rate of interest. In that case, there is a very little chance of prepayments happening quite drastically, though there is a fall in the interest rate because the fall has already occurred in the recent past a couple of times and people have already taken the advantage of that falling mortgage rates. Now they may not be in a position to take any more advantage of the falling mortgage rate. So in that case, the prepayment rates are not going to increase as it is the case of already refinancings being done. That is where we call that kind of scenario as refinancing burnout. People are no more in a position to do a refinancing because they have already done it when the interest rates have fallen very recently. So it's the path. Fall has come after an increase, and this has happened quite a couple of times in the recent past itself, and a good number of people have already taken care of that fallen interest rates where they have already done their refinancing. Then probably one more refinancing may not happen. And the other scenario where which can affect the prepayment rate is the increase in the housing turnover, especially when more and more economic growth is happening. Everyone wants a house, right? Or everyone wants to upgrade themselves to newer and newer houses, sell off the existing ones, go for a new one, which means they are closing off their existing mortgages and going for newer one. Even if the housing is becoming more and more affordable, they want to sell off their existing house, go for a new one. So such kind of scenarios where there is a high possibility of housing turnover, this also will create a kind of increase in the prepayment rates. And finally, the key aspects of the mortgage, one is the seasoning. As the mortgages become older and older, the chances of prepayment are increasing, just like the way we have discussed as per a PSA benchmark. As the loan seasons, the chances of prepayment are higher and higher, as the PSA was also suggesting 0.2% is the CPR for the first month, which will increase at the rate of 0.2% every month up to 30 months. At the end of the 30th month, the CPR could be 6% and it can stay flat at 6% up to the end of the loan. So as the loan becomes more and more seasoned, the chances of prepayment are much higher. That is one. And even the location of property is one more thing that will impact the prepayment rates. In some specific locations of the city, country, the prepayment rates are much higher, whereas in some other locations, the prepayments may not be that highly effective. So even the location of the property play a key role in terms of the increase or decrease with respect to the prepayment rates. So these are some of the things we need to be comfortable with respect to the factors that are going to impact the prepayment rates in a mortgage-backed securities transaction. Now we see from an investor's dimension, different investors are exposed to different layers of the extension or contraction risk. Probably on a very general note also, if I have to understand, not every investor will look out for early receipts. Some investors may focus more on short-term investment, whereas some of them can focus on long-term. Some of them are more and more exposed to an expansion risk, whereas some of them may be more and more exposed to a contraction risk. Now, because of these reasons, if at all the securities, if at all the cash flows that are coming from the pass-through securities, they are able to be packaged to different sets of investors having different risk levels, different combinations of the contraction risk and the expansion risk, extension risk. So probably for some of them, the contraction risk is much higher, whereas the extension risk is much lower. See, someone who is looking from a short-term investment perspective, the contraction risk is much higher for them. What is the prime reason? If they are receiving the principal earlier, right? If the interest rates are falling, they are forced to reinvest that money at a very lesser rates of interest. So they are exposed. The ones who are receiving, who are investing from a short-term standpoint, probably they are exposed more and more to the contraction risk, whereas someone who is looking out for a long-term investment, he is exposed more to an extension risk. Now, these particular instruments called as collateralized mortgage obligations, they are nothing but the whole cash flows of this mortgage pass-through securities. They are recreated into new set of instruments, probably new set of bonds, each with a different risk levels. Why we are saying different risk levels? Out of this entire cash flows, some of them may be exposed to more prepayment, some of them may exposed to a delay in the payment. So looking at it, if I can create a set of instruments wherein here, let's say the payment happens as per the schedule, and this set of payments probably they are delayed in case the prepayments slow down when the interest rates are higher. So if I can repackage these entire cash flows into a different set of securities, each with a different risk level or different combination of the contraction risk as well as the extension risk, and create multiple classes of securities. These classes of securities are what are called as tranches, and this particular application wherein I am creating multiple securities out of the underlying cash flows are called as collateralized mortgage obligations. So depending on the risk appetite of the investors, and I can really sell these different packaged instruments depending on the risk and return profiles of each of the investors. So each tranche, these are called as tranches. Each tranche has a different claim. So probably here the payments of principal and interest are completely on time. Here probably the interest may be on time, but principal may be either delayed or paid fast. So different claims against the assets, and each of these branches has a different combination of contraction and extension risk. So probably depending on the need of the investors, these cash flows can be customized and the investors can choose the one that clearly suits to their risk taking capabilities. But one thing is, whatever is the contraction and the extension risk that is present in this underlying cash flows, it is not eliminated. It is not eliminated by the CMO process. It's only repackaged. So instead of everyone being exposed to a contraction and extension risk, we are saying some set of investors will not be exposed to any of the risks. So probably they may be getting much lesser return also, but some set of investors may be exposed only to an extension risk, whereas some of them may be exposed more and more to a contraction risk. So different, it's only a repackaging of the extension and the contraction risk, and I'm not eliminating them. But because of doing this, the overall mortgage pool value as well as the credit ratings are improving quite drastically. That's one of the prime reasons of creating a CMOs against a pool of mortgage securities, or against a set of mortgage loans which are pooled as a part of mortgage backed securities. Now there are various mechanisms in which these CMOs are created. We'll look at a couple of those mechanisms where you can understand quite comfortably. There is one thing called sequential pay CMO. There is another thing called planned amortization class payment CMO. So we'll try to understand these two heavily used CMO kind of mechanisms, from where we can understand the entire process of how CMOs can help in terms of redistribution of the extension as well as the contraction related risk associated with the mortgage payments. Alright, now we will look at the sequential pay tranche. So when I am talking about the sequential pay tranche, so I'll take the same example. Let's say we have started off with 500,000 as a principal. So I will create it into two classes. So I'll create a CMO out of it, wherein I create two tranches for that principal amount. Probably I'll call them as X and Y tranches, and the principal I will try to allocate to these tranches. Let's say 400,000 for X tranche and 100,000 for Y tranche. So that's the only thing. And because it is sequential, what we talk of is the principal repayment. The principal repayment for each of the tranches happens one after the other. right? The interest repayment happens as per the schedule itself, but the principal repayment happens one after the other. That is how a sequential pay tranche works out. So here, if I say I will break it into 400 and 100, what it means is, okay, here if I have to put the collections which come to a principal, so the tranche X and tranche Y, the payments that each of these people are going to receive, the interest payment wise, the tranche Y will receive the interest on 100,000 constantly. So what was the interest rate? 6%, right? So the interest wise, the tranche Y will receive 100,000 into 6% by 12. So the interest wise, the tranche Y will keep on receiving this particular interest part, whereas the tranche X will keep receiving, so let me write this as interest. Interest wise, the tranche Y initially will be receiving 500 as the interest for the entire period. We will see where he will not, but at least up to here the tranche Y will be receiving 500 as the interest, but of course we made some mistake somewhere. The tranche Y, okay, I have to take the dollar. So the tranche Y will be receiving interest of 500, whereas the tranche X, so for time being here let me take out the, let me make the CPR rates completely as 0% across to utilize the same numerical. Okay, so the tranche Y is going to receive an interest of 500 to start with, whereas the tranche X will receive the remaining portion of the interest. Alright, these are the interests which are received by the tranche X, and at the same time he will keep receiving this amounts of principal in each of the period, which means the principal repayment part first goes only to the X. Y does not receive anything on the principal repayment because Y is a part of the next tranche. X will receive the principal at a priority, whereas Y will be receiving the principal slightly at a later date. So all these initial principals will keep going to X itself. Now, until the loan that is outstanding, comes to 100,000, when is the loan outstanding coming to 100,000? Probably by, you see here, in the 325th month or 324th month, the loan that is outstanding is $101,031. Out of that, the principal repayment of $2,492 is planned to happen in that particular month. So whatever the tranche X will be receiving in that particular month is going to be the remaining balance. So this minus of 100,000. So X is going to receive 1031, whereas from this month onwards it's the Y who would be receiving. So in this particular month Y will receive 1460 of the principal repayment, and from here onwards whatever is the principal repayment that is coming up. So which means Y will start receiving the principal as well as interest. Now from the 325th month onwards, Y will receive both the principal as well as the interest part. Whatever these are the interests, so whatever the interest part Y will be receiving, so probably what I should do is from this part onwards X will be receiving purely zeros, and Y would also receive the interest portion here. Y would also be receiving the interest portion. So from here onwards the interest portion, which Y is going to receive is only this 492, because the principal has actually come down. So it is from this stage the Y's interest part is only this, because he started receiving some amount of principal also. So this is how a sequential paid tranche is created from whatever are the payments that are coming from the underlying mortgage. What we are saying is we will break them into two or more tranches. Now a tranche X here, he is receiving the principal portion much earlier, and whereas the tranche Y, tranche is nothing but a class. The tranche X is receiving the principal much earlier, whereas the tranche Y has started receiving the principals at a much later date. That is the underlying scenario. So probably X might require the investors in X might require or might start looking from a short-term focus. They want the capital, they want their principal to be paid back much earlier. Whereas the investors in tranche Y, they might be looking for a long-term investment. They are looking for appreciation rather than any kind of quick pull-out of the capital. So we are trying to address the needs of two sets of investors, creating the principal portion of things separately for the interest is handled in the same way, it's proportionately distributed, but the principal portion of it is very carefully addressed between the tranche X and tranche Y here, right? Probably by 324th or 25th month itself, all the investor excess payments have been received, including the interest as well as the principal. Whereas for the tranche Y investor, he will start receiving his first principal payment only in the 324th month, and he will have to go until the 360th month. So there is a difference in the way the principal is received by both these parties. All we are saying is, in this kind of a structure, the contraction risk as well as extension risk, both of them are present. It's only the repackaging that is happening. So a person who is receiving the tranche X, the parties who are receiving the cash flows much early, they are exposed more and more to the contraction risk. Early receivers are exposed more and more to contraction risk, whereas they receive some kind of protection against the extension risk. Whereas when we are talking about late receivers, like tranche B in our earlier example or tranche Y in our earlier example, they are exposed very little to the contraction risk, because even if the interest rates fall, right now they are not much of impacted because they are not going to receive any big cash flows right now. but they are more and more exposed to extension risk because the prepayments can typically come down at this if the interest rates are increasing, they may not have an they are not receiving the principal portion of it now, so they lose out on the opportunity to reinvest higher amounts at a higher interest rate. So that is the one prime reason they are exposed more and more to the extension risk, but they are protected more against the contraction kind of a risk. And what we are typically seeing is the payoffs happen, the complete payoffs happen at different time periods for the different tranches, as we have seen. For the tranche X, the payment is completely getting paid out by the 324th month, whereas the next tranche Y started receiving the first payment only in the 325th month, and they will keep getting their payments until the 360th month. So wherever the time period in which they are receiving the payments, I typically call them as principal pay down window. So for the tranche X, it is 0 to 324 months, whereas for tranche Y, it is 325 to 360 months. That is the typical principal pay down window. By that time, typically the last, I mean by the 324th month, the last principal repayment is happening, whereas 324 to 360 is happening more and more for the tranche Y. And in this case, sometimes there could be one more tranche after creating two or three sequential tranches like this. There could be one more tranche that would be created called the Z tranche, or sometimes people call it as accrual tranche, which is nothing but this tranche does not even receive the principal and the interest portions initially. It's like accumulation. Whatever is their worth, it is completely an accumulation. They do not receive any principal or interest portion until all the other sequential tranches have been paid off. So their entire interest is accumulated and they are paid towards the last. So that is where we are calling as accrual tranches. All the interest during this period is accrued and accumulated. So they will be getting the balance after the principal and the interest repayments are completed for all the other sequential tranches. And in some cases, just like a fixed rate tranches, we can even have the same things happening on a floating rate, right? In some cases, even the securities can be created as floaters or inverse floaters kind of scenario. Instead of giving a fixed rate on the interest, probably it could be based on the floating or inverse floating kind of scenarios also can be very well created as a part of the sequential pay tranches. But now, the other most common CMO kind of arrangement that we see is planned amortization class, PAC. Planned amortization class tranche. It's a very interesting concept because a range is allocated initially. The prepayment estimates happen. Prepayment estimates happen based on some kind of benchmarks. So a benchmark range is taken. Let's say 100 PSA to 250 PSA is the benchmark, or 200 PSA. Now, based on this benchmark, which is the level, both the lower as well as higher benchmark levels are taken. Based on these two layers of benchmark, which are typically called as the initial pack caller. So different prepayment speeds are selected as a part of the initial pack caller, and one will have a lower prepayment rate, right? 100 PSA may have a lower prepayment rate, whereas a 250 PSA may have a higher prepayment rate. Now, what is suggested is the minimum payment that the pack class will be receiving, the minimum payment that the pack class is receiving is at least the lesser of what is given by these two repayment schedules. Whatever the principal that is coming as a part of these two repayment schedules, whichever is lower of them, that is what is going to be received at a minimum. So there is some kind of assurance based on the prepayment levels. There is some amount of assurance that is going to be expected by the bondholders of this particular class. So the because the minimum of these two is what is going to be received, what we generally see is, if I look at the principal and see, if I'm looking at some kind of numbers here, right? Let me assume that I will go with 100 PSA. So when I'm going with 100 PSA, probably this is going as 0.2%, 0.4%, and out of this, let's say I'm going to take this up to 6% up to here, and from here I'm taking 6% forever. This is a 100 PSA kind of a scenario. Now when I take 250 PSA scenario, it is probably this is becoming 0.5%, 1%. That's the way it is increasing up to this, which is coming out to 15%, and probably from here it is getting stabilized to 15%. So these are the two PSAs. Now when I'm looking at the CPR, right? CPR in the first case, and basically from there, if I want to find out my SMM, and from there try looking at, okay, so probably SMM, no, I don't want SMM now. I'll directly look at prepayment as per 100 PSA, and I will look at prepayment as per 250 PSA, right? When I am looking at prepayment here, first I will compute SMM, 1 minus of 1 minus CPR, 1 minus of 1 minus CPR to the power 1 by 12. This is going to be the SMM multiplied by whatever the principal that is outstanding beginning minus whatever is the scheduled principal to be paid for this particular period. Alright. So this is coming out to be 83 as the scheduled principal during this period, and I can take this across. And similarly here also I'll take it as 1 minus of 1 minus CPR to the power 1 by 12 times the scheduled principal the scheduled principal minus the outstanding principal minus the scheduled payment of principal. Now here, if I look at including this number also as a part of my ending period principal, let me make it like this. If I include, instead of J 1339, if I subtract this part, now if I look at it that way, I see that I have taken, this is my scheduled principal, and as a part of this process, if at all I am looking at the scheduled prepayments, let me see how much time it is taking to completely pay off. So it is so appearing that let's say by around 177th month itself, the overall payment is actually occurring. So I should look out for, these are my prepayments amounts for each of the periods. As per this, these are the prepayment amounts for each of the periods. So I'll try to add up the prepayment as well as the principal. Based on 100 PSA model, I'll add the prepayment amount plus the scheduled principal repayment amount for this period. So what is observed is, I'll copy this thing to a different location, right? I'll copy this to a different location. So these are the numbers that I'm going to get in the initial few periods, if at all I'm going to go with 100 PSA kind of a benchmark. Now what I would like to do is, the same thing I want to include as a part of the 200 PSA kind of a mechanism. Okay, I would like to include as a part of the 200 PSA kind of 250 PSA kind of a mechanism. So what I could like to look at here is the ending principal. Instead of taking P 1339, I will look out for this particular number. So this is happening with the ending principal, and I replace and I refresh it. I'm going to get these as my numbers. So now as a part of my 250 PSA, 250 PSA, my principal and the prepayment amounts put together are working out to, when I add up, these are my principal plus scheduled prepayment kind of amounts. So when I take these numbers again, carry them to a new sheet, okay, these are my numbers. Now what I would like to do is, if I start plotting a small graph by taking month, 100 PSA here and 250 PSA here. Now when I am trying to plot a small graph, what is understood from this typical graph is, as we see initially the 250 PSA values are higher, but after a certain point, probably after a few months, there is a possibility that I will see the 200 and see initially when this PSAs are higher, I am taking the lower of the two and I am assuring the prepayment. So after a certain point, it may so happen that after a certain point we may be seeing that the 250 PSA will be lesser compared to a 100 and so after 325 or somewhere. I think we have done some calculation issues somewhere. So what we typically observe is for the initial periods, the 250 PSA value will be much higher and the 100 PSA value will be much lower. Whereas after a certain period, we see that the 250 PSA will be lower compared to 100 PSA. And what we are saying is, as a part of prepayment to the pack tranche, we will minimum assure the lower of those two values, which means people can very well be assured of what kind of payments they are going to receive out of this. And this can very well comfortably happen because of a support tranche. Every pack tranche will have a support tranche which has a secondary priority. So if see as per the plan, the pack tranche should get at least 581 because it should get the minimum of these two, let's say. So the pack tranche should definitely get a minimum of 581 of the expected principal prepayment. So depends on how much prepayment has been received actually in that period. Right, a minimum of 581 is required and a maximum of 1078 will be paid. So if at all 700 is what is received, then it can very well happen that the 700 is what is being paid to the pack tranche. But if the actual received PSA is less than, if the actual received prepayment is less than 581 in that particular month, the support tranche will fund for the pack tranche, and if the actual prepayment received is more than 1078, the support tranche will be receiving that excess of principal, which so it will absorb the risk, or it will absorb the prepayment risk in case more prepayment has come out than what is being indicated by this range. So at least for a packed tranche, they are very well assured of how much they are going to receive, at least in a particular range. What is that they are going to receive during a particular period? So the more of risk assurance to the packed tranche means there is a lot of risk that is taken by the support tranche. So the risk wise, the pack tranche and the support tranche are having an inverse relationship. More and more risk protection to a pack tranche means there is a high level of risk that is taken by the support tranche. So the more and more prepayments are happening, there is a lot of amount that is going to the support tranche in the initial periods itself. So they are exposed more and more to the contraction risk, and because they are receiving more and more amounts in the initial periods itself, their average life is going to be more and more lesser. So probably I can build a relationship like this: the mortgage rates falling, prepayments increase. So because prepayments increase, average life of support tranche decreases, right? So thus even mortgage rates are decreasing, or probably if I am using higher PSA benchmark, even then the prepayments are increasing, the average life of the support tranche is decreasing quite drastically. The same will happen the other way. If the prepayment rate is very slow, the average life is getting increased, and in some cases, if the prepayment rates are very low, less than even the minimum side, the support tranche may have to fund the pack tranche to make sure that the pack tranche is receiving as per the plan itself, as per the initial caller requirement itself. So it is receiving in that particular range. So especially when we see that the prepayment rates are the prepayment rates are falling, especially it can happen either with higher PSA, or when the mortgage rates are falling drastically, the prepayments will increase, right? If the prepayment speed is increasing, we are seeing that the prepayments will increase, and if the PSA is much lesser, the prepayment will decrease. Because the prepayments are decreasing, it may so happen that the support tranche might have to fund the pack tranche, which means the average life for the support tranche will be much higher compared to the pack tranche. But when the interest rates are dull, interest rates are falling, prepayment rates increase, the support tranche receives much faster, so their average life becomes much smaller compared to the pack tranche. So we have to understand here the support tranche average life may be higher or may be lower compared to a pack tranche, depending on how the prepayment rates are happening. So this is where we have to be more comfortable in understanding that the support tranche is bearing a high risk, whereas the pack tranche is completely shielded off from the risk, right? And especially as long as the prepayments are within a particular kind of a range, we see that the support tranche the life could start right from a very high average life to a very low average life, and in general we call that particular range as an effective caller kind of a range. So this is also one more kind of CMO classes that are typically created. And just to summarize this understanding, whenever we are talking about a prepayment risk, we are looking at both extension risk and contraction risk, where the contraction risk can occur if the interest rates are falling, prepayments are increasing. Extension risk is occurring when the interest rates are rising. When it comes to the sequential paid tranche, we are seeing that the parties which are receiving the principal in the initial periods, they are exposed more and more to a contraction risk, but very less of extension risk. But the parties which are receiving more and more cash flows at a later date, they are exposed more and more to an extension risk, because they don't get initially, and if the interest rates are rising, they cannot take the advantage of that rising interest rate. So all the early tranches will be exposed to contraction risk, whereas all the late tranches are exposed more and more to the extension kind of a risk. And when we are looking at pack tranches, the overall prepayment risk itself will be much lower for the pack tranches, but it would be much higher for the support. Both the contraction as well as extension kind of risks, both of them will be much lower for pack tranches, but they would be much higher for the support tranches. So that is how we can understand the pack as well as the support tranches, or we can even think of the sequential payout kind of a tranches from that particular dimension. Another interesting concept on the same lines is the concept of stripped mortgage backed security. In a regular mortgage backed security or a mortgage pass through security, we have seen that whatever are the cash flows of the underlying mortgage pool, both the interest and the principal repayments, they are paid to, they are allocated to the investors on a pro rata basis. So, unless we are talking about a sequential pay tranche where the principal is completely paid off to the tranche X before it is paid to tranche Y. But otherwise, we see that the entire principal and interest repayments of the underlying mortgage pool, they are done to the investors, they are paid to the investors on a pro rata kind of a basis itself. But when we are talking about a stripped MBS, we look at two different instruments. All the principal only strips, means the investors who have invested in PO strips, they are purely paid the principal that comes from the mortgage payment. So, in this example, probably the principal only kind of investors will receive only these amounts or these amounts. The principal only investors will receive only these amounts, whereas interest only investors will receive only these amounts. That is what is the difference between the PO strips versus IO strips. PO strip investors receive only the principals from the underlying mortgage, whereas the interest only strip investors receive only the interest from the underlying mortgage. And when we are looking at the principal only kind of investors, we see that as the prepayment rates are increasing, they start receiving more and more principal in the earlier stages itself. Right? When we are talking about PO kind of investors, they receive, with the prepayment rates increasing, they receive more and more principal in the initial periods itself. So they are sold more and more at a discount to the par value, because at the end what the investor would be receiving is the total principal amount. So here a person who has invested in the principal only strips is going to receive the entire 500,000 during the entire period. But depending on the prepayment, I have to understand whether he would be receiving it quite early or quite late. That is what is the differentiator with respect to prepayments. So the higher the prepayments, probably more is received quickly, and the principal only strip will receive the payment quite at a faster rate. But if the prepayment rates are much slower, the PO strip investor will get the principal at a quite slower rate, thus increasing the time period over which he will receive the amount. But the entire par value is what is the total amount that would be received by the PO investor. It is only the timing during which he is going to receive it is purely determined by the prepayment rate. Whereas when I talk about the IO strip, interest only strip, if the prepayment rates are higher, the outstanding balance at the end of each month decreases. If the prepayments are higher, the outstanding balance at the beginning of each month decreases, which means the interest on it also decreases. So the IO strip will keep getting lesser amounts if the prepayment rates increase. So if the prepayment rates are higher, the PO strip is going to get more and more benefit. The PO investor is going to get more and more quicker cash payments, whereas the IO strip, forget about the quicker cash payments, he may even get lesser cash payment, because once the principal portion is getting reduced drastically, the interest portion, the interest value can keep coming down with more and more prepayment. So the overall money that the interest only strip is going to get might overall come down. Whereas when it comes to a PO strip, there is no problem of losing on the total amount. The total amount is always equal to the total outstanding principal. Whereas in an IO strip, that need not be the case. The IO strip investor can very well end up getting much lesser than what is typically expected also. So the IO investor will lose very heavily if at all their prepayment rates are much higher. But if the prepayment rates go much lower, the IO investor is going to benefit quite exceptionally in that case. So that is one thing which we need to understand. If the mortgage rates are much lower, the prepayment rates are going to be much higher, and when the prepayment rates are much higher, the interest will come out to be much lower, because outstanding principal will decrease, the interest will go much lower, and IO strip will go much lower. So the IO strip price will typically fall in terms of the falling interest rates, whereas the PO strip will gain heavily during that time. So when the interest rates are actually on a fall, the PO strip price will be going higher and higher, and vice versa. Whereas with respect to the interest rate strip, it goes hand in hand, especially at lower interest rates. It goes hand in hand with respect to the interest rates. As the interest rates fall, prepayments rates increase, which could very well result in the interest only strip payment, the cash flows to the IO strips actually falling. So what we see in case of PO strip is the person starts, the investor will get lesser amounts in the initial period, but he will start getting higher amounts in the later period. Whereas when we are looking at IO strip, the party will start getting more and more amounts in the initial phases, but as the maturity period is increasing, the party will start getting much lesser and lesser. The next aspect that is worth looking in this context is, when we talked about the agency backed securities, we said that they are either government or government sponsored kind of entities which are issuing the mortgage backed securities. But when I am talking about the non agency scenarios, they are generally created by the private entities, and the biggest thing is the backed up pool is also those particular mortgage loans which don't get qualified under the agency's pool. So the risk levels associated with those kind of loans is also much higher, typically called as non-conforming mortgage loans. Non-conforming mortgage loans. So the risk levels are much higher associated with them, which means from a agency MBS perspective, apart from the regular credit assessment, enhanced credit enhancement in some form is also required for the non-agency MBS, because they are not backed by the government or government agencies, but which means there is a lot of riskiness that is involved, and even most of the securities, most of the mortgages which are included in them, they are non-conforming kind of mortgage loans. Either they may be having a very high loan to value ratio, or they may not be they may be having a very high payment to income ratio, or the loan amount itself could be much higher. All these things generally go as a part of non-conformant. So the risk associated with those kind of loans generally is much higher, and that is one of the prime reasons we see that the non-agency backed MBS are exposed to more and more risk, which means additional credit enhancement is required for the investor to invest in them. So because the credit ratings associated with those securities also will be much higher compared to an agency based mortgage backed securities. And one more dimension that needs to be looked at in the non agency backed mortgage securities is the understanding of the commercial versus the residential aspect. So residential mortgage backed securities are primarily from the dimension of homeowners, whereas when I look at the commercial, the good thing is most of the underlying loans in commercial mortgage backed securities, they are the non recourse loan. How do I define the non recourse loans? The loan repayment will definitely happen only based on the cash flows of the collateral. So the individual cannot be approached, or individual's assets, personal assets cannot be looked at for the repayment of principal or interest. But if it is a recourse loan, which is generally like applicable for residential mortgage backed securities, if at all the repayment is not happening, even the personal assets of the individual can very well be seized as a payment for interest and principal repayment. So from that perspective, because the commercial mortgage backed securities are generally non-recourse, evaluating the strength of the commercial venture, evaluating the credit worthiness of the commercial venture is a very key aspect from the MBS standpoint. So that is from that reason, different ratios are being looked at to assess the credit worthiness of that commercial mortgage backed security. So there is a typical lookout for debt service coverage ratio, wherein we look at net operating income that is getting generated out of those properties divided by the debt service. So if the ratio is much higher, the higher the ratio is, higher the credit worthiness associated with that particular property. So even we know how we compute the net operating income. We remove the taxes, but income taxes are not removed. So the net operating income from the expected rental values minus vacancy, whatever the vacancy costs, minus the utilities and the maintenance costs, minus the property taxes, all this put together is going to give me the net operating income that is going to be associated with that property. The higher it is, the better. Then the other thing that is being looked at is loan by value ratio. How much loan amount is taken? What is the mortgage amount that is taken to the value of the property? So the lesser the ratio is, it is assessed as a better property from the perspective of creation of MBS. So more of those kind of properties included as a part of CMBS, it is less risky for the investor, whereas on the other dimension it becomes more and more risky to the investor. So, from a mortgage-backed securities standpoint, the investor needs to really look out for these kind of aspects to make sure that the risk associated with the MBS which he is getting into is taking care of to understand the composition of the various properties under that particular structure, and what are the various What are the various things that can typically be looked at to protect from a lot of prepayments in a commercial MBS scenario? What are the various steps that can typically be taken to protect against a prepayment? So there are some kind of each loan level, there are some kind of mechanisms that are typically followed. There could be a prepayment lockout, at least for first few years, 3 years, 5 years. The borrower cannot do any kind of a prepayment. That way, the credit worthiness of the underlying product is slightly enhanced. Or there is a very interesting aspect called defeasance, which means, see, if at all any extra prepayments or something that are being done, any prepayments that are being done, they need to be invested. They are invested. The company is investing all those prepayments in the treasury securities. So more and more investments that are happening in the treasury securities, the more and more investments are happening on the treasury securities, the quality of the underlying investments are getting increased. So once the defeasance period is over, the treasuries are liquidated and they are used to repay the mortgage, right? So in case the borrower is insisting on making the payment, that extra prepayments can very well be defeased. So whatever the payments that are received, they can be invested in the treasury securities, which means the quality of the MBS pool is going to be increased because of that reason. And there could be one more scenario, which is a prepayment penalty. If at all there is a prepayment that is done by the borrower, there could be a prepayment penalty that could be charged. Probably in the initial years, that could be very high, and as the time period progresses, the prepayment penalty can come down. Probably if it is like 5, 4, 3, 2, 1 kind of a ratio, it may be like 5% is the prepayment penalty in the first year, then 4% in the next, and so on. And after the 6th year, probably the prepayment penalty may not exist at all. So even that is a way you can stop the prepayments happening on the security. And we could also look at the yield maintenance charges. This is another important concept. If at all you are doing any kind of prepayment, you can put a clause saying the borrower has to pay the full interest, whatever he is supposed to pay when the prepayment does not exist. This entire interest he has to pay if he is closing the loan very early. If at all there is a prepayment that is happening, this is what is called as a make whole charge. You charge the interest, complete interest for the entire, even if he is prepaying the loan at this particular period, you charge him of this entire interest for the entire period. So which means it really should not matter if he is doing a prepayment in the earlier scenarios. So these are the various kinds of activities that can typically be taken up to make sure that the prepayments do not happen in the initial phases and the credit quality of the commercial MBS actually grows up. So these are some of the basic aspects that are getting covered as a part of the mortgage-backed securities sector of the bond market. I hope you are clear with all these aspects. In case you have any further queries or clarifications regarding the same, you can get in touch with me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.